Hello, my name is Anton Bayer, and today is the episode titled Don't Fight the Feds. So this whole year, Don't Fight the Feds, or DFTF, has been the theme for investors as Jerome Powell, the current Federal Reserve Chairman, comes out after each of their Federal Open Market Committee meetings this year. The last four meetings have resulted in a 0.75% increase in rate hikes, and investors more concerned about the Feds driving the economy into a recession. And as a result of that, every time the Feds raised the hikes, so did the stock market reverse and go down and sell off further. In June 17th, the market seemed to have bottomed as investors' hopes renewed that rate hikes would start slowing and the economy would start to recover, only to be squashed by another Federal Open Market meeting when Jerome Powell announces that rate hikes will continue. The only news that really has mattered this whole year is the Federal Reserve. And despite the fact that we have 10 million job openings for those who still don't have a job, there's plenty of jobs for them, and energy prices coming down during the summer. And then, of course, corporate profits are continuing to look strong, and consumers are employed. Unemployment's at 3.7%, one of the lowest rates since the 1940s. And more importantly, consumers have locked in mortgage rates in some below 3% and many below 4% for potentially the rest of their life. But besides that, all of that doesn't matter to investors. All that seems to matter is what the Feds are going to do this year. Now, in November, investors got pretty excited about the continued decline, the slowing of the inflation rate, the consumer price index, and that would be a direct relationship to how the Feds might respond to their rate hike policy. Of course, they raised the hikes in November, but what investors have been really looking forward to is December 14th. And that's when all year long, investors were hoping that that would be the meeting that Jerome Powell would come out and state that not only are they slowing their rate hikes, but giving forecasts for next year. Now, that is now the big bell ringer event for this year will be December 14th. And the hope is, of course, that the Federal Reserve will make a statement, Jerome Powell, that interest rates are now at a point that they're starting to feel comfortable with, and let that procure through the economy and potentially slow inflation to their target rate of 2%. So the CPI did come out today, the day before this infamous December 14th day, and indeed, consumer price index has declined, has slowed down. In fact, this is the sixth consecutive month that the CPI has slowed down. So currently, it is now on a year-over-year pace of 7.1% and well below the 9% rate of annual increases that we were facing earlier this year. That's well above the 2% that the Federal Reserve and Jerome Powell has clearly stated is their target goal. But nonetheless, investors are hoping that 7% is good enough and that the Feds may slow their rate hike policy. Our view is that they've been very clear what their target goal is, which is 2%, and 7.1% is not even close. So the anticipation of the Feds slowing or stopping their rate hike policy in 2023, in our opinion, is probably very low. However, it is possible the Federal Reserve has recognized 4 straight rate hikes of 0.75% and probably another 0.5% or 0.75% on December 14th may be enough to put in place a momentum impact on inflation and prices that going into 2023, prices will start slowing. That may be more realistic. However, the Federal Reserve will probably continue to have more rate hikes, at least in the first quarter of 2023. Nonetheless, investors and the institutional investors, they look to the future, and the future is mid-year or end of next year, and the concern is going into a recession in 2023. Candidly, we talked about the recession of 2023, probably the most anticipated recession in history. Everybody's been talking about the recession of 2023 for the last year. In fact, that alone is probably an indication why we won't have a recession, because so many people know about there's going to be a recession. But nonetheless, going into 2023 will be greatly impacted by the Federal Reserve. More information that has come out that I think is just as important is what is the rest of the economy doing? Of course, the Feds are important, but what is happening everywhere else? Well, the National Federation of Independent Businesses came out with their small business index yesterday, and that reported that small business owners are starting to show some optimism. They're well below the optimism that was just a few years ago or even last year, but nonetheless starting to show some improvement there. Now, why are small businesses important? Well, they represent 46.4% of all businesses, of all workers in the United States work for a small business, and 99.9% of all businesses in America are small businesses under 250, under 500 employees. So small businesses and small business owners are really important, probably as important as consumers, which represent 2/3 of all of the consumer spending in America. So these are very important indicators that how are small business owners feeling about the economy and their business, and how are consumers feeling about themselves? Well, we have already mentioned many times in this weekly brief that consumers are doing quite well. They've got locked in mortgage rates, as we mentioned earlier, fixed for the rest of their life, below 3% and 4%, 3.7% unemployment. More people are working in this country than in the history of this country. And more importantly, small business owners that represent the majority of all employers in this country are also starting to feel well. So what does this mean to me? Well, Wednesday, December 14th is going to be an important day, of course. Jerome Powell is going to make an announcement how the Federal Open Market Committee has reviewed the CPI and other economic indicators, and whether or not they're going to be still aggressively with their rate hike policy. Chances are there will be a rate hike, very high possibility of a rate hike policy tomorrow, but more importantly, probably a slowing or an easing of the rate hike policy. The challenge that Jerome Powell has is what he doesn't want to have is messaging to the stock market and to investors that they may be slowing interest rate hikes, and then the stock market take off. And then we're back into the same problem we had before, where consumers and businesses are growing too fast, prices are going up too fast, and now they have to step on the brakes and start raising rates again. So it'll be an interesting dynamic as we see how investors and the Federal Reserve work out this challenge of slowing the economy down and inflation while not driving the economy into a recession. So we'll be learning more about this as it unfolds, and then talking about it in our next update, how the market responds. So far, the last couple of days, investors have been reasonably positive and establishing a little bit of a mild buying rally in the marketplace with the hopeful anticipation that rates are going to start slowing down. Our view is that the patient investor in a time period when the stock market is not doing so well and the economy is stable or growing is a time period for investors to be patient, and they'll be rewarded, historically rewarded, as there will be a time when the stock market starts to recover. And let's face it, Jerome Powell and the Federal Open Market Committee will start slowing and stopping the rate hike policy at some point in time, and that will be a very positive indicator for investors. And more importantly, slowing inflation is important, and we need to see prices come into a more stable, steady growth. So that's today's weekly brief and podcast for you. We welcome anytime, give us a call or send us an email. We'd love to talk to you. And for that, we'll talk to you later. Bye.